听见资本，本期视频为您带来的是摩根大通在3月14日闭门会的关键内容，主题为衰退风险、通胀担忧及如何应对市场调整。本次闭门会深入探讨一个充满挑战与机遇的经济环境。近期，全球经济面临多重压力。美国作为全球最大经济体，其政策变化和市场动态备受关注。在这场会议中，摩根大通资产管理的专家大卫和乔丹将带我们剖析当前的经济形势，探讨衰退风险、通胀担忧以及如何应对市场调整。首先，经济增长正在放缓。亚特兰大联储的 GDP 实时预测显示，第一季度增长为负 2.4%， 这引发了市场对衰退的担忧。贸易赤字扩大、消费支出疲软以及商业投资偏弱是主要拖累因素。就业市场也出现松动迹象。2月份新增就业岗位 15.1万个，裁员公告激增，显示出劳动力市场的潜在压力。通胀方面，近期 CPI 和 PPI 数据好于预期，显示通胀趋势下行。然而，关税政策的调整可能推高通胀。美国对进口商品的平均关税率已升至 9.1%， 为1946年以来的最高水平。专家警告，关税将损害出口、制造业和企业利润，可能导致裁员和经济放缓。移民政策和政府支出削减也是讨论的焦点。驱逐出境行动和边境移民减少，可能导致劳动力市场紧张，影响经济增长。政府削减支出和裁员将进一步拖累经济，可能对州和地方政府活动产生连锁反应。在这样的背景下，联邦储备局的政策动向备受关注。市场预期美联储今年将降息2到3次，以应对经济增长放缓和通胀压力。投资策略上，专家建议在不确定性较高的环境下，通过多元化来防御，关注优质固定收益资产、国际市场和商品市场。这场会议为我们提供深入的洞察，帮助我们理解当前的经济挑战和投资机遇。接下来是英文会议的全部内容。如果您需要英文原稿和我的投研助理人工校对的中文文本，您可以在频道的 Patreon 上获取。
Good morning. My name is Brandon Hall, and I'm a research analyst here at JP Morgan Asset Management. On behalf of the team, I'd like to welcome you to today's call titled Recession Risks, Inflation Fears, and Coping with the Correction. For our call today, I'm excited to be joined by our Chief Global Strategist, Dr. David Kelly, and Global Market Strategist, Jordan Jackson. During this call, David and Jordan will discuss the outlook for the economy and markets in light of recent developments, diving deeper into how investors can use active fixed income and a broader menu of investment options to play defense in portfolios. Now, after their prepared remarks, we will be taking questions from the audience. For those of you joining us via webcast, you can send us your question using the box on the left-hand side of your screen at any point during this call. And with that, David, let's waste no more time. I'll turn things over to you.
Great. Thank you, Brandon, and thank you, Jordan, and thank you all for calling in this morning. So we thought it was a good idea to just update people on our thoughts on the outlook. A lot's been going on here on the policy front, but also a lot's been going on in markets. We had a very ugly week last week. And we've seen some stabilization in markets, but we are down today. As of right now, we're down over 9% from the S&P 500 peak. So not quite down 10%, not quite a correction yet, but of course, we're very close to that. And for a lot of investors, this probably feels like a correction after a pretty long period of really booming equity markets since October of 2022. So I think it's important to think about the fundamentals, think about the markets, but also think about how to invest in this environment. So what I'm going to do is I'm going to update you on our views on how the economy is progressing here, with a lot of talk about recession risk right now, and then also what do we think about inflation, given some of the the fears that are out there. And then also, where are we on the big policy changes from the administration in terms of tariffs, immigration, government cutbacks, and also the federal budget going into 2026. And then I'm going to pass it over to my colleague, Jordan Jackson, to talk about how we're looking at the Federal Reserve at this point, and then also investing, but with a particular focus on fixed income investing in this environment and how to diversify appropriately across fixed income. And then we'd love to open it up for any questions. So in the economy, let me talk about growth and jobs and inflation in particular here. And what I would say is the economy has seen a step down in growth. The risk of recession has risen but we are not there yet. And I think you can see that if you look at all of these numbers. So first of all, on economic growth, right now the Atlanta Fed GDP Now model is posting a number of minus 2.4% for real GDP growth in the first quarter. That overstates any weakness that we're seeing. And indeed, of course, the numbers could bounce back a little in the second. But overall, we think that there is a chance that GDP growth will turn negative. So why is the Atlanta Fed saying it's so negative? Because we had a very big trade deficit number for the month of January, a huge number. Now, we know that some of that had to do with the transportation of gold. We're trying to narrow down an exact estimate of how much that had to do with gold bullion being shipped over to the United States. But even without that, the trade deficit deteriorated. And again, some of that was probably people trying to pull stuff in, and we saw this in December before, pull stuff in before the tariffs. And if that is the case, then imports perhaps will fall rather sharply in February and March, and that will reverse some of this. But on net, we think that imports will be up substantially in the first quarter. And we think that exports could see something of a drag. And that does worsen the trade deficit, and that is a big negative for GDP. Beyond that, though, we're also looking at consumer spending. So light vehicle sales, which I think is a great barometer of where the consumer economy is, they looked pretty tepid in January and February. Weather didn't help. But overall, they're pretty much on the weak side, and certainly down from the fourth quarter, which was quite a strong quarter for vehicle sales. In the fourth quarter, real consumer spending overall grew by 4.2%. And again, that's a very strong number. And that suggests that this quarter, consumer spending is likely to grow much more slowly. And in fact, we think it may grow by less than 1%. Partly because of vehicle sales, but also, got some pretty weak retail sales numbers, ex-autos. Consumer confidence has fallen. I don't think that's too much of a concern here yet, but we're going to see some weakness in consumer spending. Business investment spending, pretty volatile quarter to quarter, but it looks like overall it's going to be on the weak side also. And conversely, though, we think that inventories, which grew very little at all in the fourth quarter, are going to grow more quickly in the first. So you add it all up, it looks like a negative GDP number somewhere between 0 and negative 1% is what we're looking at for the first quarter. And that is a little bit of a cold shower. Now, we have seen this before in this expansion. It was at the start of 2022, we initially got 2 negative quarters on GDP, which really didn't mean as much as people thought it meant. They meant we were still seeing strong employment growth. There were a lot of technical factors in those numbers. And I would say there's a little bit of technical factor about the first quarter drop off. I think it just reflects some of it's just a switch in consumer spending. But still, it's not a great start to the year. And I think in this case, unlike back in 2022, there is some sign of softening elsewhere also. So let's turn to jobs. And I'll come back to the growth outlook in a second here. But on jobs, we've got 151,000 non-farm payroll jobs added in the month of February. Nothing wrong with that. That's a perfectly reasonable number. But there were some other things that looked a little squishier. We got a big drop in employment as measured by the household survey, which is pretty volatile and hard to measure. But the payroll survey itself may have been, could have been overstating job growth. We also saw a huge number for layoff announcements. The firm Challenger Gray Christmas have for many years been producing numbers on layoff announcements. They produced a number of 172,000 official layoff announcements in the month of February, which is the highest outside the pandemic that we've seen since 2009. And that did suggest, there's something going on. And this is not just government layoffs. There's a lot going on in the private sector too. So that's a little concerning. Conversely, that the numbers on unemployment claims have yet to show any big spike. So what we could say again is it looks like we're seeing a downshift to a lower gear in terms of employment growth, but we're not ready yet to throw in the towel on growth at this stage. On inflation, we got a better than expected CPI number yesterday. We got a better than expected PPI number this morning. On the CPI number, what we're seeing is airline fares fell by 4%. And that matches anecdotal evidence we're getting from commentary from the airlines that they're seeing a drop-off in consumer and business traffic, and of course in government traffic so far this year. Again, nothing huge, nothing terribly alarming at this stage, but it is a drop-off, and it's again a very cyclically sensitive industry. So that does suggest some weakness here. Elsewhere in the consumer CPI report, we're seeing a further slide in year-over-year growth in shelter and in auto insurance. And that tells us that, barring all these policy changes, the inflation rate was headed down to 2%. And while people have justifiable concerns that tariffs are going to push up inflation, and people are certainly very focused on the price of eggs, the underlying trend in U.S. inflation is still probably downwards if it were not for the potential impact of tariffs. So that's where the economy is right now, we think. It has slowed down, it's growing more slowly, but it's still growing. As of February, the economy was growing. If you look at policy changes, though, this is really what's worrying markets. So we've seen these continual tariff announcements. This call is only supposed to go on for an hour, so I'm not going to go through all the tariff changes since Inauguration Day, but there are a lot, and it keeps on going back and forth. You saw the European Union put some retaliatory tariffs in the United States yesterday because of the implementation of steel and aluminum tariffs, and the president is threatening to put huge tariffs on imported wines at this stage in retaliation for that. And that we've got that going on. Obviously, a huge issue at the Canadian border, and Canada has always been our best neighbor and our best friend. And I think a lot of Americans are frankly distressed about this. The sudden deterioration in what's going on between the administration and Canada right now. I certainly hope that we can all get past this, because the vast majority of people in the United States do regard Canada as being our best ally and our closest neighbor. And I think that really is a sentiment, both north and south of the border, beyond these tariff issues. But we've got that. We have a tariff of 25% on stuff not covered in the USMCA, with the threat that by the start of April, the full 25% will be put on even in the stuff that was covered by the USMCA. A similar situation with Mexico. With China, the administration has put a 20% tariff on at this stage, and that is no delays, no real exceptions. And that is feeding through too. So the hardest working analyst in our group right now is a woman called Mary Park Durham. And it is her unenviable task every day to try and figure out what the average tariff rate the U.S. is applying on imports. And I think she is driven to distraction by trying to do these calculations every day. But the latest number we saw from her yesterday was a 9.1% tariff rate. Now think about that. The highest we got under the previous Trump administration was about 3%. If you go, and then it came down a little bit under President Biden. If you go back historically, that 9.1% tariff rate is the highest that we've seen since 1946. And a movement suddenly from 3% tariffs up to 9% tariffs, with the potential that we're going to go higher still as tariffs are introduced in April, that does have a significant impact both on growth and on inflation. On economic growth, we do think that it's going to hurt our exports, hurt manufacturing, hurt capital spending. It's going to hurt corporate profits. It's probably going to result in layoffs in various industries. Tariffs are not a good thing. I mean, I saw a great video from Ronald Reagan many years ago, just speaking in front of he was always very comfortable in front of a radio microphone, and he was just sort of reading off his script about all the evils of tariffs. And they really, they're economic poison. We've just forgotten this. But they do slow the economy down. People worry about the inflation effect, and I think it will have an inflation effect. If we carry through at the rate we're going and do all the things that have sort of been threatened for the month of April, if all that happens, it's quite possible the U.S. inflation rate, instead of coming down to 2% of the consumption inflation this year, could be at 3% or more on the consumption inflation this year. But it is a temporary effect, because the slowdown is for real and it's permanent. The tariffs, once you set them at a level and it feeds through, then all you've got is slow down. It pushes up the price level one time, but you have slowness. So people talk about it being causing stagflation, kind of, but it really causes inflation stag. You get the inflation first, and then the stagnation, which sort of lingers. I think that is what we could get from that. But importantly, the administration is getting a lot of pushback from the business community right now. And the real question is, at what point, or does the administration sort of back off because it realizes that a lot of people in the business community are saying, look, you're going to push this economy into recession if you keep going at this pace. And it's quite possible. It's not just the administration also. It's, we've got every 2 years, as you know, the House of Representatives is up for re-election. And a lot of Republican congressmen and congresswomen will get nervous if the economy gets pushed into recession or close to recession by tariffs. Turning to immigration, we haven't got much new data on ICE deportations. It still looks like running less than 1,000 per day, which is still significant. But 1,000 per day is about 350,000 per year if you assume that this keeps going over the weekends. And that is a lot. But we have a total of at least 11 million unauthorized immigrants in the United States, according to the Pew Research Institute. So it's still a small fraction of that. And also 350,000, of those, we'd say at least 250,000 are working. But 250,000 workers is only approximately 2 months worth of payroll employment gains. So right now, we do think that those deportations will drag on employment somewhat and reduce the number of employees and tighten up labor markets, make it more difficult for small businesses and businesses in general to find people. However justifiable these deportations are or are not. That's not, we're, as always in these calls, we're trying to be apolitical and just, that's a different decision. But I wouldn't say that the deportations themselves will have that dramatic an impact yet on the economy unless they are stepped up to a much quicker pace. What is going to have a dramatic impact is a shutdown of immigration through the southern border. If you look at the numbers, you go back to the fourth quarter of 2023, there were about 250,000 people coming across the southern border every month. That number had come down a lot to about 100,000 people per month in the fourth quarter of 2024. According to the latest numbers from the Border Patrol, that number, which is, as I say, running 100,000 per month in the fourth quarter, fell to 60,000 in January and then fell to 12,000 in February. It has basically dried up altogether. And what's going on is that there are extra troops on the northern side of the border, extra troops on the southern side of the border. If you're captured, they're just going to throw you back across the border. And I think as opposed to having an immigration hearing or an asylum hearing, that I think is having a big impact. I think there is a chilling impact from the very tough messaging coming out of the White House, which is discouraging people from trying to cross the border illegally. And of course, that discouragement is a very good thing. I believe it is. I think it's important that people immigrate in the traditional manner by getting a visa and immigrate that way. We have not yet seen a significant decline in the number of visa applications that have been approved by foreign embassies. That number was just over 50,000 for the month of January, which is kind of normal. But we'll have to see how that plays out in the months ahead. If that number was to fall also, then we have some significant issues. Because you could have a situation where if you ramp up deportations to, say, 600,000 per year, and virtually nobody's sneaking over the border anymore, and actual people applying for visas falls below the 670,000 for all of last year, you could hit a situation of net zero or negative net immigration. And in the United States, if you have negative, or if you've got zero net immigration, the working age population age 18 to 64 will fall by about 800,000 people per year. And so what you could have happen is later on in the year, you simply run out of it. You can't find construction workers. You can't find retail workers. You can't find restaurant workers. And you'll see employment fall. Maybe wages go up a little bit, but you'll see employment fall because of a lack of supply. And that also could, impact the economy going forward. And then you've got government cutbacks. As I mentioned, we have these huge layoff announcements of which about 60,000 of them, calculated by Challenger, were in the government sector. We don't have any official numbers coming out of the federal government on layoffs. I will tell you that the weekly unemployment benefits survey, which does the government layoffs, the federal government layoffs don't actually show up in the headline number, but they do have a line item for it below, so you can sort of see federal layoffs. And the numbers that came out at 8:30 this morning still don't show a spike in federal layoffs. We think it's going on. We think it may be just delayed in hitting these numbers. We don't know how big it is. But again, it can slow the economy. I mean, over the course of this year, the federal government's got 3 million civilian employees, if you include the Postal Service. If you cut total federal employment by 300,000 over the course of this year, which seems quite plausible based on the rate that they're going right now, then that's a 10% cut, 300,000 jobs, again, about 2 months worth of job growth. So it would drag on the economy. Government efficiency is obviously something to be, we need to achieve. The problem is that managing a government is and an economy is very different from a business. In a business, if you cut your employment by 10%, it doesn't do anything to your demand. In the big macro economy, if you cut federal employment by 300,000 workers and those laid off workers lose salaries, they have to sell houses, they stop spending as much money, they stop buying cars, then it actually feeds into demand of the economy and slows the whole economy down. Now, all of these things suggest slower growth this year. And so while we're not ready to call recession right now, if you had a second quarter in which you have a further spike in tariffs, an acceleration in deportations, and an acceleration in government layoffs, you might well get a very weak second quarter or even a negative second quarter, in which case I think you would be in a recession. I would say the recession risk is still below 50% right now, but it does depend a little bit on how everybody responds. Now, Jordan's going to talk a little bit about how the Federal Reserve might or might not respond to news so far. Let me sort of wrap up by talking a little bit about how foreign countries are responding, but also how the U.S. Congress will respond. So let me start with the U.S. Congress. Right now, they are trying to send a bill through to keep the government open past tomorrow. It seems a little stuck in the mud right now, but I think what's going on is the House passed a bill which wasn't quite a clean just extend, just keep the government running for a few more months. It had a few things that the Democrats really didn't like in it. They sent this on to the Senate. The Senate can filibuster this. The Democrats in the Senate can filibuster it, and the Republicans don't have the 60 votes to get past the Democrats. What I think is going to happen is there's presumably some negotiations going on between John Thune, the Senate Majority Leader, and Chuck Schumer, the Democratic Minority Leader. I'm sure that there are negotiations going on right now, and the gist of it is, look, you're going to have to give us something here if you're going to avoid a filibuster. Give us a few things here. We'll pass the bill through the Senate, and then we'll send it back to the House and sort of dare them to pass that or to reject that. Both sides really don't want the government to shut down right now, but I think at this stage the Democrats are so mad that they require some piece of some gift from the Republicans in order to avoid this. And I think the easiest thing for the Democrats to do is see if they can get a bill to pass the Senate or compromise on a bill that will pass the Senate, and then leave it on House Republicans to pass it. Because if the government shuts down because the House Republicans didn't pass it, then I guess the House Republicans get blamed. I mean, it's all very silly, of course, but that's how I think we are where we are. I don't expect a long-term government shutdown. It might happen. I think we probably will avoid it. But if it does happen, I think it'll be relatively short. And the compromise will be one in which essentially House Republicans have to give something to the Democrats to avoid a Senate filibuster. That's what's going on here. But I think the other thing to think about is they're also working on the big tax bill. And the weaker the economy gets, the more likely it is that you're going to have additional fiscal stimulus in this over and above the extension of the Tax Cut and Jobs Act of 2017. Because remember, if you just extend that tax cut, then you don't really provide any stimulus to the economy in 2026. Right now, the economy doesn't need any stimulus. But if we have a recession, the economy certainly will need some stimulus, and that's what members of particularly the House Republicans and the Senate Republicans will think as they go into midterm elections. And so it's quite possible that big tax bill will get bigger if the economy weakens here. I do expect, either one or two bills. The Speaker of the House, Mike Johnson, seems to think he can get it done in one bill. But at the moment, I do think you'll see some tax cuts, certainly a corporate tax cut, some R&D expensing and equipment expensing, something on perhaps Social Security tips and overtime, although not the full promise the president made. But I think you will see some stimulus cooked in for 2026. And then looking at the rest of the world, all of this is having a big impact outside the United States. I'm not sure that, in the United States, we don't get much news of the rest of the world. And growing up in Ireland, I'm very aware of the fact that it's completely different overseas. Overseas, people know everything that's going on in the United States. It's reported very extensively in the news. And the Canadians obviously are pretty shell-shocked by what's been going on. But the Europeans are also shell-shocked, particularly on Ukraine. And with the result of the German election and the which simplified things in terms of getting rid of the debt brake and expanding German spending, and with the administration's pullback from supporting Ukraine, I think the members of the European Union are very concerned that their own safety from a defense perspective is not being protected anymore by the United States, and they're going to ramp up defense spending. And so I think that you will see a lot of European unity. I think there'll be unity in putting retaliatory tariffs in the United States for every dollar that we put on tariffs on them. But I think you'll also see a ramp up in spending in the European Union, which may help the European Union grow more quickly. And then on China, we're seeing some further stimulus in China. I think there's more excitement about AI and DeepSeek in China, which is helping out the Chinese stock market. I think it's still the Chinese economy is still in a weak position. But overall, I would say the global economy is not strong enough to cause inflation, but not weak enough to cause recession. Our issues are mostly our issues. But I do think that the worries in the United States right now, both about the tariffs and about the possibility of recession, that is pushing down the dollar. It is remarkable to see that so far this year. I was just looking at the numbers before we started this webcast. As of last night, DM equity outside the United States was up 9%, and U.S. equities year to date was down almost 5%. That is a very unusual shift in fortunes here. But it reflects the fact that the dollar has been coming down in this tariff war, unlike what we saw back in 2017 or 2018, 2019. But it also reminds us that people need to invest around the world, not just here in the United States, because right now things in the United States are pretty volatile. So I'm going to leave it there. Sorry, I spoke a little longer than I intended to, but I'd like to turn it over to Jordan now to talk a little bit about what all this means for Fed policy and for investing. Jordan?
Great. Thank you so much, David. Thank you, Brandon. And thank you all for joining us here. I first want to spend some time talk a little bit about the Fed, what we expect next week, and what we think will play out over the course of this year, although it's very difficult to say definitively at the current state. Then turn to talk a little bit about the fixed income market, talk about a little bit about how 2024 played out given the elevated level of interest rate volatility that we saw, and then how bonds are continuing to perform actually pretty well so far over the course of the start of the year. David talked a bit about international. I'll provide some comments around international as well, talk a bit about commodities, and then I think we can open things up for some questions. So first on the Federal Reserve, so they meet next week, Wednesday. We don't anticipate any changes to the Fed funds rate, and so keeping that policy rate at 4.25% to 4.5%. Turning to the statement, we don't think there are going to be any meaningful changes to the statement language. I think it's still too early for them to sort of backtrack on the disinflationary narrative that we're seeing. And I think it's also still a little bit early to talk about any sort of worries around the broader economic growth backdrop, although there are obviously still concerns around growth. Obviously, I think, and typically in the press conference, Powell has to field a number of questions. I do think he's going to have to field some questions around the potential negative print for GDP, highlight that a lot of that is really a trade story, not necessarily a domestic demand story, looking at real personal consumption through the first quarter, which again has slowed a little bit, but remains still in decent shape. The markets are currently pricing in about 70 basis points of Federal Reserve easing for the course of this year. So that is somewhere between 2 to 3 rate cuts. Since the start of the year, markets were right at the Fed's forecasts of around 2 cuts for this year. So that's certainly shifted in a bit more of a dovish direction. I would say that our outlook for the Fed is somewhat binary here, in a sense that at least currently we do expect the Fed will be able to deliver roughly 2 rate cuts over the course of this year. But on the other end, it's likely that if they have to cut more, it's likely going to be cutting in response to a recession. And so if you think the Fed's, roughly in our view, the Fed's going to cut roughly 2 times, that's a backdrop in which growth continues to hang in there. Inflation maybe continues to disinflate or maybe stalls out a little bit. But that gives the Fed enough room to be able to cut rates modestly. And then on the other end, we could, again, recession risk has increased, and we could be looking at a recession, and we expect the Fed to respond more aggressively in rate cuts in response to a recessionary environment. Turning to yields in the Treasury market and how they've evolved, and I think maybe take a quick step back. Rate volatility was very, very elevated over the course of 2024. You consider the range of the U.S. 10-year last year that it reached a high of 4.7% and a low of 3.6%. So again, a very, very wide range and elevated interest rate volatility. But even in that backdrop, the U.S. Ag was up about 1.2% last year. Short-term investment-grade credit was up about 5%, and U.S. high yield was up about 8%, reflecting the significant amount of spread tightening that we saw in corporate credit markets. So far this year, on balance, yields across the Treasury curve are lower. It's pretty much been a parallel shift downward. The 2-year is down by about 25 basis points, 0.25%. Equally, the 10-year is down about 25 basis points so far this year. But what's fascinating is the bond market is very much reflecting the sort of inflation stag comments that David talked about. In that you get that immediate sort of inflationary shock, but that longer-term growth lag. If you break down the changes in the nominal 2-year so far year to date, again, the 2-year nominal is down about 25 basis points, but the real yield component, which is sort of a reflection of near-term growth prospects, is down by about 90 basis points, but the inflation component is up by about 65 basis points. So again, the short end of the curve is very much still reflecting that kind of inflation stag tint at the very, very front end. But if you look at the long end, the 10-year, again, the 10-year is down by about 25 basis points, but that move has been effectively entirely by the real yield component. So sort of a permanent sort of hit towards growth, but no changes in terms of the longer term impacts that tariffs may have on inflation. So I think that's pretty interesting. And now, if we turn to sort of fixed income more broadly so far year to date, again, while on balance, yields are down, bond prices are up. The U.S. Ag is up about 2% so far year to date on a total return basis. When you look at investment grade corporate bonds, they're up about 1.5%, whereas high yield is up a little bit less, about 1.3%. And generally what we've seen more broadly in credit markets is this backdrop where spreads have been widening out a bit here. We reached tights in November of last year at around 74 basis points on investment grade corporate credit spreads. We're now up to about 94 basis points on corporate credit spreads. High yield spreads are also higher by about 25 basis points as well. And I do think, again, this is reflective of some of the riskier parts of the market needing a little bit more default compensation on the backdrop of recession risks that have increased. I will say that there is a risk that we could see some further widening in credit spreads. Historically, when you look at recession probability estimates of around 25%, you tend to see investment-grade corporate bond spreads in the neighborhood of around 120 to 130 basis points. So that would suggest that at least in the near term, we could see some further spread widening. But that again would be potentially in a backdrop in which Treasury yields come down a little bit, maintaining the attractive income that we're seeing in the bond market today. And so when we look elsewhere, sectors that we like in the broader fixed income, we still like asset-backed securities. We think particularly upper-end consumers are doing okay. The yield in this relatively shorter dated asset class continue to be relatively attractive. We're remaining higher quality within our bond portfolios. We're seeing that play out, being reflective in the more spread widening in the high yield market year to date than we have seen in the investment grade credit market. But we still like the fundamentals within the municipal space. Rainy day funds as a percentage of general spending are around 12 to 13% in the top 14 states from a GDP perspective. So fundamentals still remain quite strong in the municipal bond space. And you know, again, within the leveraged loan space and CLO market, while we recognize that floating yields are still quite attractive in the 8 to 9% range, in an environment in which recession risks are increasing, we could start to see some pressure in those markets. But on balance, you can continue to look towards core, high-quality fixed income to provide insurance in the event of a growth slowdown. And we are perhaps looking down potentially at a bit of a growth slowdown here. And so we do think that core fixed income is going to continue to play a ballast towards client portfolios as we're seeing so far to start the year, and continue to hedge against equity market risk. We've seen the negative correlation, stock bond correlation to start the year. Now, that being said, bonds have proven to be that good diversifier for equity risk in a growth slowdown. If there continues to be an increased risk around inflation uncertainty, you could see that relationship, that stock bond correlation, start to drift a bit more positive. So we want to be careful there. And so what that means is, again, for insurance against equity market risk, an economic slowdown, we like the intermediate high quality core fixed income. For those purely seeking income, we think shortening out that duration, perhaps the 2 to 4 year part of the curve. Again, we think corporates are in pretty different shape, so default risk relatively low in the near term. You tack on maybe 100 to 120 basis points worth of corporate credit spread, you can get yourself to around a 5.5% yield at the 2 to 3 year part of the curve, and perhaps be able to sleep at night. Although I have a 7-month-old and I haven't slept at night for quite some time, so yes, I would like to be able to sleep at night over the next 2 to 3 years. So generally, we do think that is really the sweet spot right now. So that's generally what we're seeing in the broader fixed income space. As David highlighted, right, in international markets, it's been interesting to see some of the outperformance coming from international assets. Europe ex-UK is up 14%. As David highlighted, the EFA developed market equities are up about 9%. A big driver of that are economies and equity markets like Germany and France. Talked a little about the lifting of the debt limit in Germany. So after years of fiscal austerity, finally starting to see some fiscal stimulus, which should be supportive of the European economy. Then also when we look at developed markets, it's really been two stories there. One, on the banking industry and European banks and financials performing very, very well. And then aerospace and defense also performing very well also. If you think about the banking industry, I try to remind folks about 5 years ago, we were talking about trillions of negative yielding debt and the experiment of global central banks with negative interest rate policy. That has changed dramatically. And so for a period of time where banks were losing money just purely off policy, they're now turning and actually making money again. And so we're seeing a resurgence in sort of confidence in the banking industry. And we recognize that Europe is as an economy, is very sensitive to the banking industry and bank lending. And so that's perhaps allowing some of these animal spirits in developed market equities to come back. And then again, being able to increase spending, again, specifically in Germany, but for broader Europe, on defense and aerospace, that's providing a nice tailwind to the sector as well. And we think both of those dynamics, there's some durability there in terms of developed market equities. Emerging markets haven't done as well. EM more broadly is up about 3.7%. China has made a nice tactical sort of rebound here. We'd like to see a little bit more fiscal as well as monetary stimulus. You're going to need it in order to reach that 5% growth target that they have for this year. But again, we continue to see, again, maybe a bit more tactical markets around announcements coming from the PBOC and the Chinese government. Elsewhere, when we look at other markets like commodities, commodities have also done particularly well. Gold, silver up about 11% year to date. I think that is to some degree a bit of a flight to quality, a bit of safe haven. We have seen a number of central banks increasing their purchases of gold. On the industrial metal side, copper also up around 20% year to date. Aluminum up about 6% year to date. I think a lot of that has to do with potential for tariffs, supply chain challenges, and the continued fundamental demand for some of these industrial metals within the EV space and the renewable energy space. So commodities actually proving to be a bit of a portfolio diversifier for client portfolios. And so it's been interesting to see that as well. Maybe turning back to fixed income, I forgot to mention a little about global bonds. It's been a different story, whereas rates on balance have come down in the U.S. Rates have generally moved higher across global central banks. But interestingly, and this sort of feeds back into the comments about the dollar, whereas in local terms, many developed market bonds and emerging market bonds are actually down on the year. Because of the weakening of the dollar, as a U.S.-based investor owning global bonds, you're actually up somewhere between 2 to 3% on these global bond portfolios, depending on where you shop. So I think that's an interesting dynamic, and we actually do think that global bonds will continue to play a bit of a diversifier. The ECB, the BOE are still in the cutting camp. We know the Bank of Canada cut rates again as well, and so that should provide a bit of support for global bonds. Just to sort of wrap up here and then open things up for some questions, we continue to believe that the best way to play defense in an environment of elevated uncertainty is through diversification. And we're seeing diversified portfolios perform particularly well over the course of this year. As advisors, the best thing we can do is continue to sort of handhold our clients here to not walk off of a cliff, so to speak, and move all the way to cash. There's still a number of opportunities within the market on the public market side, and even within private markets as well. When you look at markets like real estate, you need to be careful not to paint real estate with one broad brushstroke. But we do think we are seeing a bit of a bottoming in real estate prices across office and retail. Industrial vacancy rates continue to remain at very, very low levels. While we have seen a little bit of oversupply coming from the multifamily space, where mortgage rates are and where home prices are, the reality is if you can't afford to buy the home, you're going to have to rent for longer. And so that the fundamentals in that market continue to be relatively well supported. Obviously, the sell-off in the market has put a little bit of cold water on private equity activity, but we do think that private equity multiples have come down a little bit, and we could see M&A activity beginning to pick up as well in the back of potential deregulation coming down the pipe. So those are some high-level comments around broader asset allocation and the bond market. I think now is a great time for us to open things up for some questions.
Of course. Jordan, David, thank you so much for your comments, and thank you all for sending in your questions. We're getting a lot of them coming in. Jordan, why don't we stick with you here? You noted some of the strong performance we've seen from global markets outside of the U.S., Europe, China, et cetera. We're getting a lot of questions as to whether or not you view this as the beginning of the end of U.S. exceptionalism, or do you see a more balanced market moving forward? What's your thoughts there?
Well, it's interesting, right? The sell-off that we've seen, particularly in U.S. markets, has been relatively concentrated in tech. The defensive parts of the market are actually playing some defense here. Healthcare is still up. Materials, REITs are still positive so far year to date. So the defenses are playing defensive. And so I wouldn't say that this perhaps is the end of U.S. exceptionalism. These tech companies have strong balance sheets. They have strong cash balances. They're investing in their businesses in a heavy way. But we recognize that they came into the year very much overvalued, and there were risks there of a slowdown. But we would say that we think this rally or strong performance coming out of international is durable. There are some structural changes here that I think provide a bit of support towards these markets that we know are a bit more cyclically value oriented. I talked about the interest rate environment continue to benefit international banks. In a market like Japan, companies are becoming more shareholder friendly. So increasing dividend yields, increasing buybacks, so rewarding shareholders. And so we think that is a dynamic that will continue. And within emerging markets, right, some of the more commodity sensitive, you look at a market like Brazil, for an example, that's up in dollar terms about 8% or 3% in local terms. We've seen a broad basket of commodities sort of continue to do well. That should feed through to perhaps commodity exporters doing well also. So I wouldn't say this is the end of U.S. exceptionalism, but perhaps more shared exceptionalism in global investing.
Perfect. Thank you, Jordan. We're getting one more question on international a lot. Over the past couple months, even the past year, really, we've talked about this concentration within U.S. equity markets. But if we zoom out a little bit, global equity markets, global equity market indices are also largely concentrated in the U.S. And so what would a broader sell-off in U.S. equities, should it occur, mean for global markets? And how should investors consider that when allocating abroad?
Well, we have always sort of believed and observed that when the U.S. sneezes, the rest of the world sort of catches a cold. But I think to some extent, the structural dynamics I talked about in international, so some of the secular trends as well, things like population growth in markets like India and growing middle class. The need for semiconductors. It takes a long time to build a new manufacturing plant here in the U.S., where they're already well established in parts of Southeast Asia, particularly Taiwan. And so, I think you could continue to see a bit of weakness. And also, I would argue that valuations are a lot more elevated here in the U.S. than they are across the rest of the world. You're getting a pretty steep discount by going international versus investing in the U.S. And when we actually look at the fundamentals, earnings revisions, you're seeing earnings revisions turn positive in markets like Japan, some parts of the markets in Europe and emerging markets as well, where you're actually seeing net negative revisions coming out of the U.S. And so we could very well be ushering into this period in which the U.S. sneezes, but the rest of the world has their mask on. And so, it again kind of gets back to that earlier point, perhaps some shared exceptionalism here.
Thank you. I like that analogy. David, let's turn things over to you here. We're getting a lot of questions or people wondering if you could dive a little bit more into the consumer, particularly delinquencies that we're seeing on credit and auto loans, for example. Do you take that as a sign of weakness, or what's your key takeaways from rising delinquencies there?
Yeah, no, it's a concern, but we expected to see this, and we're seeing delinquency rates rising, but they're still relatively low compared to the period before the pandemic, before the great financial crisis. So I think we need to keep this in perspective. I think another perspective that's really important is that about 2/3 of consumer debt is mortgages, almost all that is fixed rate mortgages, and so it's not particularly sensitive to the increase in interest rates that we've seen. And indeed, we've got if you look at the debt service ratio for households, it's still pretty low relative to what it was before the great financial crisis. So I don't think that we've got a crisis here, but it's an issue. And I think another way of thinking about it, the problem is that recessions start quickly and then start slowly and then move quickly, and that's kind of what happens. So what you could have happen is you've got these rising delinquency rates, and yes, it's not, they're focused on lower middle income households, not the upper income households who've really done very well recently. But if recession fears cause banks to get tighter on credit card debt, or if we're stupid enough to put a limit on credit card interest rates, which would be a economic disaster if we did that for various reasons. If you do those things, then you may see a reduction in the growth in consumer credit, and that, of course, would be just part of a general sogginess in the economy. So there's some risk there, but I think it's not so much from the delinquency rates themselves as how banks might react to those delinquency rates, but also a greater threat of recession.
Perfect. Thank you, David. We're also getting a lot of questions regarding tariffs and how they relate to consumers. So the question we're getting often is, when do you expect to see the impacts of tariffs show up in consumer prices, and then how could consumers react to that?
Yeah, and by the way, I know that we'll keep this call going for another 10 minutes because we've got plenty of questions here, so we'll try and wrap it at noon Eastern. So I think it won't take long. I think you're going to see, we saw, in the February report, we didn't see much in the way of CPI inflation. I think by the time we get the March and April reports, we'll see some of it. So right now, as I said, we're in early March still, or mid-March, and already the tariff rate is up at 9.1%, and that's a lot higher than it was, a month ago. So that I think will feed through to higher prices this month and going into next month. We have to look also prices at vegetables coming in from Mexico, which I think is going to be an issue. And then if we get further rounds of tariffs on the start of April, that'll feed through in April and May. So I think it may be a step up that takes us all the way into the middle of the year. And then if we reach an end game on tariffs, no matter how high they are, then at least we'll know where we stand. I do think that this will ultimately slow the economy down. You're already seeing global oil prices have fallen. And remember, the dollar has been falling. So the fact that you've got WTI in the 60s now, in a year where the dollar has been falling, suggests that there is a significant slowdown in global oil prices and global commodity prices coming from all of this. That'll act in the opposite direction. But I think we'll see a ramp up in the CPI reports in March and April and May and June. By about July, we may reach a peak of the inflation that's coming out of these higher tariffs, assuming that at some stage we decide to call it quits on raising tariff rates.
Perfect. Thank you, David. We're going to stick one more with you, but shift gears a little bit to the other side of the policy agenda, particularly federal spending cuts or federal budget cuts. We're getting a lot of questions on how cuts to federal spending could impact activity at the state and local government level. And then, Jordan, maybe we'll come to you. I know you talked about munis a little bit, but dive a little bit deeper into what slower activity there could mean for the municipal bond market.
Well, yeah, so let me take the first crack at this. I think there's a chilling effect right now because many state governments and local governments run their budget from mid-year to mid-year. And so, as they think about how they're supposed to budget for what will be fiscal 2026 for them, they're going to be cautious because they know there's going to be cutbacks in government money. I think in particular the state Medicaid programs are really under threat here. Medicaid is a program that is administered by the states but largely funded by the federal government. About 70% of the money comes in from the federal government. And if you look at the blueprint the House passed for the budget resolution, it's looking for about $880 billion worth of cuts over 10 years in a broad or in a department which is mostly about Medicaid funding. So if you see a dramatic cutoff in federal or reduction in federal Medicaid funding, that's going to feed through to the states. And the states have got one of two choices. They can either raise taxes and keep the same coverage, except it's very, very hard to get a state tax increase through, or they will cut back in coverage. And that means cut back on, perhaps some state local government employment. I think you'll see that. But also, I think it'll have a knock-on effect on the hospital sector around the country. So, we haven't seen it yet. I think the problem with all this stuff is we can see the problem that's going to emerge in the data. We just don't have the data yet. So I do think there'll be a problem over the next 6 months if, as these different cutbacks are fleshed out. And again, the question is, how aggressively are they implemented in the short run? If this is all, these are all spending cuts we're going to do in the 2030s to pay for tax cuts now, well, that wouldn't be surprising, but it'd be kind of typical. But then it doesn't have as much of a macroeconomic impact. But if we follow through, if we're as aggressive on cutting government spending and grants and aids and loans as we have been in cutting government employment under the Department of Government Efficiency, then it will have a significant impact on those state and local governments, but also on universities and on a lot of private education, research, charitable organizations around the country who depend on federal aid.
Thank you, David. Jordan, I know you spoke a little bit about munis in your prepared remarks. Do you have any comments to add regarding impacts on the munis market, given what David just mentioned?
Yes, I think David highlighted nicely. Obviously the healthcare sector is a bit at risk here. Also, universities. I can share a specific story. Talking with some of our muni managers, in which the Department of Education, the DOJ, and the DHHS announced a cancellation of about $400 million in federal grants and contracts to Columbia University. Now, Columbia University is a AAA rated institution. And while the details were a little bit scarce in terms of which grants and federal aid would be canceled, that sum amounts to about 6% of Columbia University's operating revenue. But I would also, on the other end of that, mention that Columbia has a $14 billion endowment. And so generally, if you should extrapolate this out, we are leaning towards the higher quality municipals that have really strong balance sheets, that have high levels of source of revenue and general fund spending. And so long as again, municipals sort of came into this period in really, really good shape, and we think on balance they can weather sort of this policy fog and political storm in the quarters ahead.
And obviously, in the university space, what you say, Jordan, is absolutely correct. If you are a very big, well-known university with a massive endowment, then you can weather the storm and just use the endowment to some extent to deal with a drought in government aid. But for smaller colleges, less well-known colleges with smaller endowments or virtually insignificant endowments, they could have some significant problems here.
Perfect. Thank you both. I think we have time for two more questions. One we'll bring to you, Jordan. We've seen inflation move lower last month, but the broader trend really over the past 5 is that it's been ticking steadily higher. And we've seen signs that the labor market, while still solid, is showing some signs of softness here. So, Jordan, the question we're getting as it relates to the Federal Reserve is whether you think the Fed is more sensitive to the inflation piece or the unemployment piece of their mandate at the current moment, or both.
It's a good question. I think next week, Chairman Powell will say the same statement that he made at the last press conference, in that we don't guess, we don't speculate, and we don't assume. And right now, the disinflationary trend is still intact, and it could sort of stall out, but the Fed doesn't have the data in hand just yet. So I'd argue, and actually looking through some of the Fed meeting minutes and some of the recent commentary, that the Fed is perhaps a bit more concerned around the growth side of things than they are on the inflation side of things. Now, again, that could change as we start to see, David highlighted that, in the February CPI report, this really only accounted for the additional 10% tariff increase on Chinese imports. We obviously have much broader tariffs that are in place in March, and perhaps even more tariffs in the coming months. So we'll see how that feeds through. But we should remind ourselves that monetary policy by adjustments in the Fed funds rate have no impact on supply side driven inflation, which is what tariffs are. And so they may, in fact, look through the near term impact on tariffs. And so long as the broader disinflationary trend is still intact, they're going to be a little bit more sensitive, I'd argue, to the growth side of things.
Thank you, Jordan, very much. One last question here we're getting. It's a broad one, so we'll give both of you the chance to answer. The question we're getting more than once within the Q&A session is, what would you tell to a client who is panicking right now?
Well, I would say just remember that, that their investment horizon is a lot longer than what, as I said, they change the House of Representatives every 2 years. They change the president every 4 years. Your investment horizon is a lot longer than that. Don't worry about the American economy. We may, there is uncertainty. We may have a recession. We've had recessions before, but every recession has been followed by a recovery. This is still an economy of long summers and short winters. It's still a country in which 340 million people wake up, they want to work more hours, they want to buy more stuff, and they want to get ahead. This is a very powerful economy, and if we have a recession, it'll recover, and financial markets will reflect that. Don't worry so much about that. Worry about what you own. It's very important. If you have a bear market, you know not the day nor the hour. I mean, right now, just as I'm looking at markets right now, we have just. I said, don't worry about, coping with the correction. We're exactly 10% down now. So we have a correction, and people will be concerned about that. That's not really a signal one way or the other as to whether they should get into the market. I think the more important thing is recognize that corrections in bear markets, not the hour nor the day, but you do know the location. Bear markets tend to be worse in things that had no fundamental foundation in the first place. So if you buy good companies and good assets around the world. As Jordan was saying, there are plenty of good fixed income assets, but there are also plenty of good equity assets in the United States, in value, in many companies outside of the mega caps. There's a lot of opportunity in global equity markets. There's a lot of opportunity in alternatives. So I think it's important for people to get invested in long-term assets. Remember, if we do end up with a recession, then guess what's going to happen? Those short-term interest rates, which look great right now, they're going to vanish. Long-term investors should be long-term investors. But this is a time to think about investing and look closely at valuations and the reasonableness of investments when you make them.
Thank you. Jordan, anything to add, or are you all set?
I would just say volatility is normal. It is the price that we pay as investors. The average largest intra-year correction is around 14% going back to 1980, and we're not even there yet. And we typically see about a 10% correction in the market on average at least once a year. So volatility is normal. You think about a year like 2020, where the world was ending and markets were down 30%, but up positive by the end of the year. And so, keep volatility in perspective. We're here for you and your clients. And thank you all for joining today.
Yes, thank you, everyone, very much. I will say we have a ton of questions here, many of which we may have addressed or will look to address in some of our publications in the future, whether that be our notes on the week ahead, our policy hub. So I'd encourage you to check out the materials that we put out currently and keep your eye on them in the future as well. But Jordan, David, I want to thank you both for joining us today, and thank you everyone who tuned in. If we did not get to your question, please reach out to your JP Morgan representative, and someone from our team will be happy to get you an answer. Thank you very much. Have a good rest of the day.